I was not able to become a consistently profitable trader until I understood these three concepts that I'm going to share with you in today's episode. One of the things that's really frustrating about learning how to trade is that on the one hand, it's very easy to get started. You can set up an account on your phone, or certainly of course on your computer. You can set up your charts and your scanners, and you can very easily press the buy and sell button. And like a lot of beginner traders, I naively jumped into the market thinking that I would find success early on. But in my first few years, I was the statistic of another failing trader. I kept adding money into my account, I would lose it, I would add more, and I would lose more. Now you might think that that's crazy, why would anyone do that? But if you've been trading for a while, you know the experience. I would have a few green days, maybe even a few green weeks, or even a green month, and I would feel like I was starting to get it. I was this close to turning the corner, but then inevitably I would have another setback, a spiral. And I felt like I would take 2 steps forward and then it was like 5 steps back. And while on the one hand, I was defeated, on the other hand, every time I had a couple of steps forward, I felt like I was getting it. All I need to do is have more days like this back to back and fewer of the big red days. Now, there's also a blessing and a curse in the market. You may have heard me say it before. The curse of the market is that, like me, you could spend years sitting in front of your computer every single day, showing up early, trading the markets, and not making even $10 a day consistently. And it's infuriating because you're not trying to get rich. You're not trying to drive a Lamborghini or fly in a private jet. You're just trying to make a little bit of money, $10, $20 a day. And you can't even do that. You feel humiliated. You feel so discouraged and frustrated. Now, here's the blessing in the market. Once you have a strategy that is consistent, the only difference between making $10 a day and making 100 or 1,000 is increasing your share size. But you won't make even $10 a day consistently until you have a strategy and a set of rules that you follow, that you have the discipline to follow every single day. Now, the first concept that I needed to understand in order to become a consistently profitable trader was that there is no such thing as a strategy that is right 100% of the time. I think for me, when I came into trading, I had a lot of fear. I didn't have a lot of money. I was very attached to the money that I had. I didn't feel like I could afford to lose it. And it was money that I had gotten from my father when he passed away. So I had a real emotional attachment to the money. I wanted a sure thing. I wanted to put my money into the market and, pull profit out every single day. And so I was looking for a strategy that would have basically no risk, that would have no loss. And unfortunately, that's not realistic. And so I fell into this habit where I would sort of learn the basics of one strategy. I'd sort of get a sense of, oh, this is how one strategy works. I would take one trade, and if I lost, I was like, that's it, I'm never trading that again. And that's a really bad way to approach it, because let me just give you, for example, my strategy right now, over the last 8 years of trading, roughly, my accuracy is like 68%. It's good. It's not great. I mean, it could be better, but 68% is kind of where I'm at. So let's just say you sat down and traded my strategy and you took one trade. Well, you'd have a 68% chance that that one trade would be a winner, but you'd also have a 32% chance that that one trade would be a loser. And it's very possible that that first trade, just because of the luck of the draw, would be a losing trade. And it would be very easy for you to say, oh, this strategy is garbage. It's junk. I'm never trading that way again. I'm going to just switch to something completely different. And what you might end up doing in that moment is basically discounting and writing off a strategy that really does work, but will have a certain percentage of the time where it just loses. And that is okay. In fact, and this is something that's really hard for a lot of beginner traders to get their mind around, which I think is why so many beginner traders fail. Losing is part of succeeding. So what do I mean by that? Well, if I'm wrong 32% of the time, is it really wrong to have those losses when in totality, those losses are part of a strategy that produces millions of dollars of profit for me? It doesn't feel like it is really wrong. That's just the percentage of the time where I follow all of the rules, but I don't come out with profit on that trade. But the strategy is a winning strategy. So for a lot of traders, we're looking at each individual trade and we want each individual trade to be a winning trade. But that's a very narrow-minded way of looking at things, and it's tunnel vision, and that's going to get you searching for what I would call the holy grail, and it doesn't exist. There is no strategy that's right 100% of the time. In fact, the only traders in the market that make money every single day aren't traders at all, but they're the brokers, the broker dealers. And I suppose even they occasionally will have a bad day where, for whatever reason, somehow the firm loses money. I mean, we've heard of this happening. So it's an illusion to think that there is a strategy out there that will be right 100% of the time, which means a really important concept for you to grasp is that loss is not only okay, it is actually part of succeeding. So I like to call successful red days, days where I may lose money, but where I followed all of the rules of my strategy. I respected my max loss on my trades. I stopped out when the trade was no longer working. I didn't get stubborn. I didn't average down. I didn't hold my losers hoping they would turn around. And I didn't, following a loss, start gambling with my account by jumping from stock to stock to stock, hoping that maybe one would make a big move. And when you do that, you generally are abandoning the criteria that your strategy has set forth for the type of stock that you should be trading. So when I think about all the traders I've known who have failed, I'm thinking about and remembering a lot of traders who stumbled upon a strategy that may have been very good, but they gave up on it. They didn't see it through. They didn't trade it for 100 trades and to see what's my total profitability over 100 trades. And you know what? Even if they had, let's just say that their profitability over 100 trades, maybe for me is 68%, but for them was only 50%. Is that because the strategy doesn't work? Or is that because they have not yet mastered the nuance of the strategy? Traders are so quick to abandon a strategy that doesn't produce profit and to run to something else. But these are traders who are flip-flopping. They flip from long to short. They flip from large caps to small caps, to futures, to Forex, to cryptocurrency. They're just jumping around the market. It's almost chasing your tail. And I understand where you come from when you're doing that, because I did the same thing. You're searching for profit, you're searching for certainty, and you're afraid of loss. And if what you're doing is causing loss, you don't want to stick through it. But I want to encourage you to think about this. Most traders lose money. We know that. That's a fact. What are the successful traders doing? The successful traders find a strategy and they stick with the strategy. So you've got to really get comfortable with mastering one strategy. I like to say that in trading, and no pun intended, you don't want to be a jack of all trades and a master of none. Being a jack of all trades means, you're so-so at a lot of things. You're not going to make money in this incredibly competitive and aggressive stock market if you can't be a master of one strategy. But if you can master just one strategy and you find that you can be consistent with that one strategy, that can be enough to start making that $10 a day. And then once you're doing that, you go from 10 to 20 to 50 to 100 to 200 to 500 and so on. And then that's when you can start venturing into adding strategy 2, strategy 3, strategy 4. So for me, I would say that my strategy at large is momentum trading. I'm a trend-based trader. I don't try to fight the trend. I trade with the trend. But within that strategy at large are a number of subsets of strategies, times of day that I trade. Many of you have heard me talking about my gap and go strategy, where I'm trading stocks that are gapping up. But I also have subsets of different patterns that I focus on, and each have different degrees of profitability and success. And so there are times when the market's colder that I'm going to say some of those strategies, not worth trading. And there's other times when the market's really hot where I'm going to, sort of fold them back in and say I should be trading all of these. So as a beginner, it starts with just one. And having the conviction to stick with that strategy comes from the second important concept. So the second important concept is the realization that most people who try to day trade lose money. So we have to do a few things with this information. First of all, we have to understand why they lose. Doesn't it make sense that if 90% of traders fail, that we should try to understand the mistakes they're making so we don't make the same mistakes? I know I want to learn from the mistakes people made ahead of me. I want to avoid falling into those same traps. That's common sense. I think it is for me at least. So on the one hand, I want to think about and try to understand why so many traders fail. Now I'm in a unique position where I have people that are sending me messages all day long in YouTube comments or sending me emails. And so I have a really good sense of the reason that traders fail and the mistakes that they make. I'm going to share a few of those here with you right now. One of the first mistakes that most beginner traders make is that they are trading without a strategy. They have an absence of a actual strategy. So in other words, they're doing what I did as a beginner, which is a little bit of trial and error, a little bit of this, a little bit of that, kind of jumping from strategy to strategy, but they're not even really strategies. They're just trading maybe AMC or trading a little GameStop or trading a little Tesla or Nvidia. They might be trading kind of the hot stock or the hype in the market, but really it's sort of a buy and let's see what happens type of strategy. If you fall into the camp of traders that is currently trading without a strategy, you should know that that is a leading cause of failure. The second leading cause of failure is that a trader has a strategy, but they don't have the discipline to follow the rules of the strategy, which I know feels crazy. You've got the roadmap right in front of you. All you have to do is follow it. And yet what we've learned is that the emotions that are generated when we experience the gains and the losses of trading are so great that it's easy to deviate from our predetermined roadmap plan or strategy. And so one of the reasons that a lot of these traders will have a strategy but fail to follow it is because they did not lay a solid foundation by first trading in a simulator. You've got to trade in a simulator and you've got to practice the strategy that you're learning, because by trading in a simulator, you build a track record. A track record creates a sense of confidence and of achievement. So let's just say, for example, you're a beginner trader. Like me, when I got started, I had a little bit of beginner's luck, not much. And then I started losing money. I'd have a couple more steps forward and then another 5 steps back. 2 steps forward, 5 steps back. And this was what it was like for me, except it was with real money. So first of all, having this experience in a simulator takes so much pressure off because it's not real. You know, there's disappointment and frustration because you're spending time learning how to do this thing, but at least you're not losing real money. So you go through this experience in the simulator, but then you go through what is a very important part of the learning curve, which is you go initially from losing money to break even. Being a break-even trader is really important. This is phase one, this is phase two. Phase two of being a break-even trader means that you're starting to understand how to make money, but every couple of days or weeks or whatever it is, you give back what you made. It would be easy to discredit phase two as not being anything different from phase one. You're still not making money, but not losing money is actually a huge milestone. You're holding your head above water. You're treading water. And the difference right here between going sideways and beginning to pull away and make progress ultimately is simply having those big red days a little less often. They're a little fewer and further between. And that, for most people, is the difference between going sideways and being profitable. One of my students who's got, I think it's his 500K badge right now, he said something really interesting, that there wasn't for him a very specific turning point in his career. It was just, he said, I started sucking just a little bit less. I started having big, terrible red days just a little less often. And all of a sudden, it was like between the red days, he would start to have just slightly longer periods of success. Still had a red day, but then just slightly longer periods of success. And that right there is where you go into phase three and you're starting to be consistently profitable. Now, this is still happening in the simulator. So having phase three in the simulator, now it gives you a track record where you've got actual metrics that back up the strategy that you're trading. So what you do after having at least, I generally would say 6 weeks of consistent profitability in a simulator, that's when you flip the switch and you go live with real money. And when you go live with real money, you start with really small size, 5 shares, 10 shares, just tiny size. And what you have to do is prove that you can maintain those same metrics. And you literally start just with that goal of $10 a day. But now it's real money. If you have the misfortune that on your first day with real money, you lose, you have a track record that you can go back to, and that is your source of confidence. This is the track record of, this is how much I've made. I know what I'm doing. Okay, so today was a red day, but that's all right. So the biggest mistake the beginner traders make is that rather than setting a solid foundation like this, they just jump in naively with real money. And I made that same mistake. And I want you to know that it's never too late to take a step back and switch to the simulator. Put your real money account on the shelf just for a little while. Humor me. Do it for a week. Do it for a month. Just practice in the simulator. See if you can produce the metrics of profitability. Because if I'm going to be honest, if you can't make money consistently in a simulator, you really don't have any business putting real money on the line. I wish I had understood that when I got started. I understand it now. So if you want to avoid being part of the 90% of traders who lose money, don't trade with real money until you've got a track record of profitability in the simulator. So now that you've laid a solid foundation by trading in a simulator before going live, when you do go live, you are more likely to have the discipline to follow the rules of the strategy because you have all of this data that supports why you need to follow these rules. You may still have the emotional impulse after a loss to deviate from your plan, but when you look back at all your metrics, you know that when you follow your rules, you do well. And when you trade with real money, but with really small size, the emotions are so much smaller than when you trade with big size. So what most traders do who end up finding success is when they transition to real money, they're trading with small size and they're slowly increasing size. They're doing this because it allows them to go through the process of conditioning themselves to the experience of having loss. It's emotional conditioning. So you have losses, but they're small with 10 shares. So the stakes are low. Okay, I lost $3 today. It's no big deal. I'm not stressing. And then the next week they go up to 20 shares, then they go up to 50, then they go up to 100. And naturally the profits will get bigger as they're doing that and the losses will get bigger. But it's a lot easier to slowly condition yourself up to experience $100, $200, $500 losses than to just come out on day one and suddenly be down $500 in 3 minutes. When a beginner trader does that, that's the point right there where they start to spiral. They go off the rails, and next thing you know, they're down $3,000, $4,000, $5,000 on the day, and the account is gone on day one. Now, as part of this second concept of understanding that 90% of traders fail, we of course want to avoid making the mistakes that all of those traders make. But on the other hand, we don't want to just think about the losers. We also want to think about the winners. What are the 10% of traders doing who are making money that's working for them? What's their strategy? In fact, we want to learn everything we possibly can about traders who are making money consistently. Because ultimately, if you think about it, if you were doing everything that they were doing and you had the same disposition, you had the same aptitudes, you had, everything was exactly the same, you would expect that you would perform well, that you wouldn't be a losing trader. And so there's always a gap between what the incredibly elite traders are doing and what you're doing. And even for me, I'm not at the level of other traders. There's still a gap. So there's always gaps between traders. But if you can understand sort of the anatomy of what those traders are doing, what their strategy is, what the rules are that they follow, and what you're doing right now, then you can kind of create a list of how to get from A to B. So one of the things that I really encourage is for you guys to learn from traders who are proven profitable. I will put a link in the description for this video where you can download my small account strategy as a PDF. You can learn the rules that I follow. Now, if you don't like my strategy, you don't have to trade it. Practice it in a simulator. But I just encourage you to learn from someone who's actually proven profitable. You can see my audited broker statements are on my website. So if you're curious about my profitability, it's right there for everyone to see. But this is, unfortunately, when it comes to the day and age of social media, a problem where there's a lot of people that talk a big game, but they don't have broker statements to back it up. So just make sure if you're going to spend the time learning a strategy from someone, whether it's futures or Forex or options or whatever it is, that person that you're learning from is proven profitable. If you've done that, then you know that they are part of the 10%, right? Without a doubt. They're part of the 10% who succeed if the strategy for you is a good match for your risk tolerance, for your account size, for what you're trying to achieve, and you feel like this is someone that you can learn from, they're being transparent, they want to help you learn, then that's someone that you want to get really focused in on. What are they doing? What time of day are they trading? How are they choosing what to trade? Why are they buying where they're buying? Why are they selling where they're selling? If you can really dissect all of that, that's going to put you in a really good position. That's part of laying a solid foundation. Now, the third concept that I needed to understand before I was able to find success as a trader is that there is no such thing as a technical indicator that's right 100% of the time. Just like in concept one, there's no such thing as a strategy that's right 100% of the time. The same is true with technical indicators. In fact, I spent my early years on a hunt for what I called the Holy Grail. I felt like Indiana Jones. I was looking for this perfect technical indicator that would always be right. It would give me the buy signal. It would give me the sell signal. All I had to do was blindly follow it. And the reason that I needed that indicator was because I didn't trust myself. Now, that's very interesting. I didn't trust myself, and it makes sense. I shouldn't have trusted myself. I didn't have a track record of success in the simulator. I didn't have metrics data, historical data to back up that I knew what I was doing. I wasn't learning from someone who was proven profitable. I was shooting from the hip. So it makes sense that I was insecure and that I was searching for the holy grail of technical indicators. But I've seen a lot of you guys post charts where you've got a million indicators on the chart. And so I want to help you kind of understand something, that what's more important than indicators. What's more important than reading an indicator is your ability to read, understand, and predict sentiment in the market. And this is what I've gotten so good at as a trend-based trader. I understand when people are really excited, when there's a lot of enthusiasm in the market. When we've got something like GameStop or AMC, or we've got Nvidia or Tesla, I'm happy to trade those when everyone's hyped up about them and everyone is trading it and it's going higher and higher. But I need to be able to know when to get out while the going's good and how to not overstay my welcome. Now, if you look at my charts right now, you'll see that I really do have very simple charts. I have candlestick charts, simple Japanese candlestick charts, and the indicators that I have, I'll just write them down here so you know. These are my indicators. I use EMAs, exponential moving averages. I use the 9, the 20, and the 200. They're all EMAs. That's it. Those are my indicators that I use on all time frames for moving averages. I use volume weighted average price, VWAP. So number 1 are EMAs, number 2 is VWAP. Number 3, I use MACD. Now, MACD is an oscillator. And so when I say oscillator, what I mean is that it actually oscillates. It goes up and down, as you can see right here. So this is the MACD down here at the bottom, and it oscillates between positive and negative, right? Positive and negative right here. And this is a really good way of visually picturing trend. So the reason I like it is because it helps me have that kind of, that double check, or that gut check of, I think that we're still trending up, but let me just check the MACD. So when I pull up the MACD, that'll show me very clearly when the trend is shifting. So this is a spot right here where MACD crossed over. I see that crossover and I recognize, okay, it's time to step back. Now, if you want to learn more about how I use MACD, I have separate videos exclusively going into depth of how to use MACD in your trading, why I use it on the time frames I use it on, so on and so forth. But I really try to keep my indicators simple. So I've got my EMAs, my VWAP, my MACD, and then number 4, of course, volume bars. And I suppose number 5, you could just say is the candlesticks themselves. I don't know if you would say that's really an indicator, but I'll throw it on there. So this is what my charts consist of, and that's it. So the thing that's really important is that I'm able to see the pattern and the shapes that the candlesticks are creating. So for me, this is like the most important thing, are the actual shapes of the candles, because what I understand is that each of these shapes communicate sentiment. A lot of beginner traders struggle with this. And it's understandable why you struggle with it, because learning to read candlesticks and becoming an expert, becoming proficient at reading candlestick charts is like learning another language. The reason is it's like a visual language where the different shapes of the candlesticks that we see, each of these candlesticks, they communicate sentiment about the market. So I'll just do this in this color, but I know very clearly that each of these different candlestick shapes have different meaning. So when I see these in different, of course, on different charts, I understand each one of these and the context behind this candle of what it means. So it takes time to be able to learn the subtle language of the markets. But for me, I don't want to cloud my ability to see the candlesticks by putting on a ton of indicators. What I really want to be able to do is focus on understanding trend. As a momentum trader, I like to buy stocks that are moving higher, and I don't like to trade stocks that are going down. I'm not a short seller. So I focus on trading stocks that are moving up, which means we know that no stock goes straight up like this. Stocks will climb up and then they'll pull back, and then they'll climb up and they'll pull back, and they'll climb up and they'll pull back. And so this is a trending stock. So when I'm seeing this right here, I need to be able to differentiate that this is a place to buy, it's a pullback, and it's not the beginning of a reversal back down. Now, my indicators will help me with this, but the individual shape of the candlesticks combined with looking at the volume bars right here, these ultimately are what's telling me whether this is a place that I should be buying for the next leg up or I should be selling. Now, I have another episode that I've taught called The Only Candlestick Pattern That You'll Ever Need. This is a great class for those who haven't already watched it, where I go into detail about these very specific patterns that I trade during a period of trending price action. But ultimately, that third concept that I really needed to understand is that indicators are not the end all be all. What I really need to get good at is reading sentiment, to be able to predict what the collective, community of traders are looking at each day, what they're liking. Is the sentiment strong? Are people buying? Is it exuberant, or is there fear in the market? Once you get really good at taking that temperature in the market and understanding when people are buying and when there's excitement versus when people are hesitating and it's slow, that's when things really start to connect. And I like to say that for me, one of my skills is learning how to lean in and sort of double down when the market is hot and then quickly take my foot off the gas when it starts to cool off. Some people think that a trader, if you've got historical data, well, that data tells you these are your metrics, these are your analytics. You should just always trade with the exact same position size every single day, rain or shine, no matter what. And I would argue that's a bad idea, because in a really hot market, doesn't it feel like this is the time, if there were ever a time, to take more risk, to be more aggressive, to trade more frequently? And on the flip side, during a time when the market's really cold, when the market's really poor, isn't that a time to ease off the throttle, to cool down, to take some risk off the table? But that subtle touch of knowing when to lean in and knowing when to ease off, that's something that takes time. So experience or educated intuition, there's no way to earn it other than sitting here in the chair every single day. So for me, ultimately, it took years before I became consistently profitable, but I don't think it would have happened if I wasn't able to fully understand the three concepts I've shared with you today. I hope learning them will help you in your trading. And as always, I encourage you to download my small account strategy PDF. And if you want to keep learning from me, make sure you hit that thumbs up and subscribe to the channel for more episodes about trading strategy just like this. As always, I'll remind you that trading is risky. My results aren't typical, so manage your risk, take it slow, and please practice in a simulator before you put real money on the line.